Hello dear friends, I am Ram. Welcome to FinShoppy. So today in this video we are going to discuss about differences between PPF and NPS and suitability for the investors and how much return you are going to get if you invest for a fixed tenure in both PPF and NPS. So let us see all these details in the presentation. PPF is a government funded scheme, whereas NPS, National Pension Scheme, is government sponsored pension program, which can be opened by the public, private, unorganized sector employees. Who can invest in PPF? Any resident individual can open PPF account, and also in the name of minor, in the capacity of the guardian of the minor, can also invest in PPF. Non-residents are not allowed to open PPF scheme. In case of NPS, any citizen of India, either resident or non-resident of India, are allowed to open NPS scheme. Individuals aged between 18 to 60 years are allowed to participate in this scheme. Minimum investment amount would be 500 in case of PPF and maximum would be 1,50,000 per year. So even if we invest more than 1,50,000, government won't pay interest on it. So please note this point. In case of NPS, minimum investment would be 1,000 per year. There is no limit for the maximum investment. Come to maturity period, PPF mature in 15 years. Extension is there in a block of 5 years as many times as you want. You can withdraw amount at the maturity. So maturity amount would be tax free. In case of NPS, you are required to invest up to 60 years age. So at the maturity, you need to convert 40% of the maturity amount as annuity for the pension. Come to tax benefit. In case of PPF, it is considered as a triple E product. It means while contributing and while earning and while withdrawing in PPF, it is completely tax free. So under section 80C, 1,50,000 per year, you can avail tax benefit for PPF investments. NPS is EET product. It means while investing it is tax free and while earning it is tax free. While withdrawing, partial amount is tax free and some amount is tax free. For NPS under section 80C, 1,50,000 you can get tax benefit. In addition to that, for additional 50,000 you can get tax benefit under section 80CCD. So while maturity, 60% of the maturity amount would be tax free for NPS also. Come to asset classes. Whatever amount which you are investing in PPF would be invested in government bonds in case of PPF. So total investment would be completely secure and safe. In case of NPS, your investment would be invested in different asset classes which are equity, government bonds, corporate bonds and alternative investments. As these investments are market linked, returns would be volatile at times. The most important point is suitability. PPF is suitable not only for the retirement but also like kids education, kids marriage or buying any property, because maturity period of PPF is only 15 years, which is relatively a smaller maturity period than NPS. Most importantly, if you want assured return and your investment safety is paramount important for you, in that case PPF is more suitable for you. Come to NPS. Unlike PPS, sole purpose of NPS is for the retirement. So at the maturity at the age of 60 years, 40% of the maturity amount you should convert as annuity. So NPS investments are suitable when you are thinking retirement pension. If somebody is thinking to invest in PPF for retirement pension, so in that case you would better to think about NPS, as you will get a bit more return by taking volatility risk. So bottom point is, it depends upon the purpose of the investment. You can choose either PPF or NPS. Come to expected rate of returns. Current rate of return for PPF is 8%, which is subject to change by the government. Every quarter government assesses the rate of return on the PPF. It may keep it as it is or it may increase or it may decrease. So over a long period of time, reasonable expectation from the PPF would be 8 to 7.5% kind of return. Come to NPS. For aggressive and active mode of investments, you can expect around 12% rate of return, but you have to take volatility as asset classes under NPS are market linked. Come to expected returns from PPF and NPS. In this table I have taken 1,50,000 investment for each PPF and NPS for the tenure of 20 years. Expected rate of return for PPF would be 8% and expected rate of return assumed for NPS is 12%. So maturity amount after 20 years for PPF would be 74 lakhs and for NPS would be 1 crore 21 lakhs. Difference is very huge because over a long period of time compounding plays very good role. While deciding between these two, financial goals are very much important. If you are thinking about kids' education or kids' marriages, and if you want returns should be safe and fixed returns, then you can go for PPF. If you are thinking about retirement pension and if you wanted to take bit more risk for the higher return, you can surely think about NPS. I am done about this presentation, friends. Hope you like this session. To take informed decision, please do share it to your friends and subscribe to my YouTube channel if you haven't done. Thank you so much.